Very good morning, everyone. First of all, I would like to thank TimesPro for giving this opportunity indeed to share my experience and insights working on central bank digital currency initiatives across various central banks to TimesPro blockchain community. So today's key agenda and topic is a deep dive into central bank digital currencies, what they are, what are the design choices, and the landscape, the CBDC landscape. But we'll also try to look at how they compare to stable coins, cryptocurrencies, and what is the impact of CBDC on adoption of these cryptocurrencies. And will it augment the trust on central bank? So we will talk various aspects of central bank digital currency. And coming to myself, as Vimalesh introduced, I'm heading Information Data Systems, a Michigan-based company, as a vice president for blockchain practice and products. And I'm chair for Hyperledger Governance, Risk and Compliance Special Interest Group, and alumnus of IIIT Hyderabad and Liverpool Business School. And as a product leader and as a solution architect with over 10 plus years of experience, I led many production grade enterprise blockchain applications across various domains like supply chain, trade finance, central bank digital currencies, telecom, HR verification as a service, GRC, enterprise NFT marketplaces, and now working with Ministry of Education and AICTE to build world's largest educational metaverse by name Polyversity, which was launched by Dharmendra Pradhanji, our Honorable Higher Education Minister, a couple of months back. And also led a certain blockchain solutioning and consulting for energy accounting, air cargo operations. So, I mean, I have experience, expertise, leading applications, building applications, and decentralized applications, especially on both public blockchains and permissioned blockchains. And indeed, my passion for sharing knowledge is what makes me a subject matter expert. I upskilled over 200 plus fintech leaders across Singapore, Europe, and Dubai, Central Bank of Nigeria, based on, I mean, various courses, cohorts. And I upskilled 1250 plus working professionals, product leaders, undergrads, grads in blockchain through various certification programs, which we do at IDS. But coming to my expertise, I enabled organizations in their blockchain strategy, solution architecting, implementation roadmap, their go-to-market. So this is a brief intro about me. And of course, for my contributions to the blockchain ecosystem in the country, IBF, India Blockchain Forum recognized me as one of the top 50 blockchain influencers in India. Of course, all these tags put more responsibility on whatever I'm talking and going to talk now. And I'll make sure whatever I share comes from my internal working with various central banks. So today's agenda would go like this. For first 40-45 minutes, we will talk about the following outline, and then the last 10 to 15 minutes we'll put up for Q&A. And in order to make the presentation flow smooth, I request anyone having questions or concerns or perspectives, you can put them in Q&A section, and I will address them in the last 15 minutes during the Q&A session. Okay, so now let's look at the agenda. First, we'll talk about evolution of money, right? Because we are going to talk about central bank digital currency. Obviously, we need to talk about currencies, money, how it evolved, and where we are now, right? And where we are heading. And then we will talk about the rise of digital currencies, be it cryptocurrencies or stable coins. And then we will, I'll set the context of how central bank digital currencies become the new foundation for programmable money by the central banks. Okay, and how central banks are now trying to leverage the same technology, blockchain, which is leveraged by cryptocurrencies, to retain certain capabilities crypto brings, and also to retain the sovereign control over money as a concept. And then we will see the global CBDC landscape, what is happening across various central banks across the world, what are the various initiatives around central bank digital currencies. And we will talk about flower of money as defined by Bank of International Settlements, that is BIS, which is a consortium of multiple central banks in the world to work on innovations required for central banks. So that is the fourth point, which fourth topic which we'll discuss. And then we'll see central bank digital design choices like direct CBDC, indirect CBDC, hybrid CBDC. And then we'll talk about how CBDC implementations are scoped, right? So sometimes CBDC comes as a retail CBDC or a wholesale CBDC or a multi CBDC. So we will talk about each of this. I will define them and I'll try to quote certain examples so that you understand what happens in that particular scope of CBDC implementation. And then we will see CBDC versus cryptocurrencies versus stable coins. And what is this tip about CBDCs trying to minimize the adoption of cryptocurrencies. And we'll also see if crypto really goes off if CBDCs comes mainstream. Right. So this is the hot topic which I'll talk about. And then we'll conclude with certain closing remarks on how money is going to evolve and where we can see ourselves in future when we deal with money. So this is the agenda. So let's start with the first slide for today. That is evolution of money. See, if you carefully observe, one of the amazing things humanity invented is money. If you carefully observe, thousands of years before, when human civilization is in its very early stages, where only small groups of communities used to live, at that time, money used to be decentralized. What do I mean? It used to be peer-to-peer. No central banks, no treasuries at that time. It is only bartering. So the first form of money, the first form of medium of exchange of value used to happen through bartering. Now, if someone asks me like, okay, Arvind, what do you or how do you define money? It is very simple. It is a medium of exchange of value. Now, that medium of exchange of value in the early human civilization used to happen through bartering. That is, if you have what I want, if I have what you want, let's exchange the goods. But then slowly, salt, in certain communities, salt was used, and in certain communities, seashells, rare earth metal based medium of exchange of value used to happen. But as this human civilization or human communities expanded, obviously what happened is it is very tough to find the one who has what I want and who also has a need of what I have. So at that point of difficulty, human created money as a concept. And what he did is he or she, humanity as a whole invented this concept of money, which is backed by rare earth metals. Because obviously you can't use something of infinite quantity to be used as a medium of exchange of value. Because if something is available infinite, its value tends to zero. So obviously something of limited quantity only can be used as money. That is why human used rare earth metals like bronze, copper, silver, gold as a medium of exchange of value. But then fast forward to 1800s, what happened? All the gold was amassed by British Empire through looting, through attacking other countries, bringing back all the valuable things. So we know the history, we know the past. And India as a British colony, we know what horrible things was done by British. And they amassed huge volumes of gold. And what they did is they came up with the treasury concept and they came up with convertible note. So after gold coins were issued by each kingdom, and each kingdom used to have a seal treasury who manages that coins, eventually what happened is British came up with gold standard. And when British came up with this gold standard, what they did is, meanwhile, China invented paper. And when that paper got invented, to move money, it has become a costly affair. And to avoid that or to minimize that, paper-based money was invented. And that is somewhere in 1800s, where people used to deposit the gold they have at the treasury of the central bank, and central bank used to give a note equivalent of value of gold to the citizen so that they can use it for their day-to-day transactions. And that is what called as gold-backed or convertible note or gold-backed currency. But fast forward, by 1940s, 50s, US emerged as US dollar has emerged as a petrodollar and as a reference asset or reference currency for all global transactions. So whenever globally cross-border, if they want to do transactions, all world came with Britain's Wood agreement, because of which US dollar has become a reference currency. And that means whenever someone does transactions, they need to use US dollar conversion value as a reference. And that is how we got US dollar dominance in the world. But again, the innovations in IT happened, and digital payment rails like electronic payments have become a way for doing the digital transactions. So slowly we brought electronic payments, which are settled by central banks. So every central bank in the world has their electronic payment network to which all the banks connect. Like say, if you take in India, right, we have this IMPS, NF, what is that, NEFT, right? And instant payment systems like UPI. All these are managed by central bank or central bank owned subsidiaries to facilitate the interbank settlements and peer-to-peer settlements. So central bank, so if you carefully observe the overall history, what happened is money which used to be peer-to-peer decentralized slowly became centralized and came into the control of central banks, which is nothing wrong, of course. But the problem is, if the governance at the central bank is not going good, then the trust on the central bank goes down, and the value of the currency issued by that central bank also goes down. Now, to tell you a story, somewhere in 2001, when US World Trade Tower attack happened, to bring back the economy to rails and to encourage the growth in the economy, fractional banking system. So somewhere in 1971, so sorry, I'll go a little back to 1971 and then I'll come back to 2001. So in 1971, what US president at that time did is, he came out of gold standard. That means US can print currencies which are not backed by gold reserves they hold. Rather, they said, our economy is not just based on the kind of gold reserves we hold. We have an innovative economy. We have space tech, that tech, military tech, whatever tech they have, that tech helped them to move out of the gold standard, break the Bretton Woods agreement, which was initially drafted, but then became a petrodollar, and they can print as much money they want, of course, which is managed in the fractional banking system. So in a fractional banking system, a bank need not maintain 1:1 ratio of the reserves to cash. Rather, the cash to reserve ratio can be like 20%, 10%. That means every dollar deposited in a bank can create $10 worth of loans. So every loan given, every government scheme which comes out, every subsidy which comes out of government, every company which takes a loan from the bank, all these are broad money, which is created based on the leverage banks have on the cash to reserve ratio, which they maintain with the central bank. Of course, I know some of the group may not be domain experts in banking or central banks, but I mean, I'm giving you very key terms so that you can explore further after the session. Okay. So in the fractional banking system, if banks are unable to bring back the loans, then the value of the currency falls and the inflation goes up. Okay. This is basic economics principle. Now, somewhere in US, somewhere in 2001, when US government decided, or banks, federal government reduced the interest rates for housing from 6% to 2%, people can take house loans at very low interest rate, which made people to take money as much as they want from the credibility they have. But at that time, there is no credit bureau system, centralized credit bureau system. It is pretty much individualized to the banks. So what happened is, at that time, each bank has their own credit limit. Now that means, say for example, I have $100,000 worth of credit with one bank, okay, bank A. I go take 100,000 from bank A, 100,000 from bank B, 100,000 from bank C. What happened? I took over credit, which which I don't know if I can pay back or not. That way, more money came into circulation. That means, obviously, lesser the value of the currency becomes. Now, for all the non-domain experts who just came to session to understand in simple terms, let me tell you, what your grandparents got for 1 rupee, your parents got for 10 rupees, we are getting for 100 rupees. Why is that? Inflation. Now, inflation can happen in two ways. One, there is more circulation of money coming into the system, which is not backed by the real economic activity and value. That is one. Or second, more and more businesses are failing in terms of matching the supply and demand. And that is how the value of the currency may get influenced. And this is what central banks moderate, right? But the problem is, each central bank has sovereign control within the boundaries of their country. But what other central bank does is not under the scope of this country. That means there is no global trust. Every central bank is taking the decisions based on their country's interest, based on their country's economy, based on the government which is being led, which is leading that particular country. So that way, by 2008, the value of money which is spent on housing is more than the actual value of the real estate, and all the banks in US are on the verge of bankruptcy. And at that time, Federal Reserve, because lots of jobs are dependent on that, what they did is they written off all the bad loans and they infused new money into the system. That means already the money which is given as loans is in circulation, and the new money which is infused is also in circulation. And during COVID also, we saw around 25% of the circulation of US dollars went up and came into the system. That means if one central bank has luxury to print money and give and subsidize free money into the system, that people will take the supplies across the world, by which increases the prices across the world. So one thing I want to highlight is, if the governance of money is in one central authority, of course, whatever political reasons it is, at the end of the day, if that is not backed by real value, that will create global ripples of inflation, which is making the value of money go down. So that is when 2008, we saw the rise of cryptocurrencies. And an intention to solve it is what the Bitcoin journey got started. And we know what Satoshi Nakamoto, the creator of Bitcoin, who is unknown today, anonymous for many reasons, has created a programmable money concept. So he wants to, so what was decentralized initially has slowly become centralized. but the governance of money and the debt of money, the debt around the around the economies is not is creating a loop in which the whole economy is collapsing across, and the value of money going down day by day, day by day, day by day. And it is to bring visibility to the total supply of money. A new concept was introduced in 2008, that is cryptocurrencies, that is Bitcoin. Now, what is Bitcoin? It's a cryptocurrency, as you all know, which is managed by public, because the ledger is maintained, the infrastructure is a decentralized network or a distributed network of computers maintained by public. The transactions are facilitated by that network, and the ledger is maintained across all the nodes. That means we know all the network is driven by a protocol. So Bitcoin was introduced as a programmable money, where the circulation of money comes step by step, and there is a total fixed supply, and there is visibility to the total supply of money in the system. And this is what he created as a concept and started experimenting. But it caught up like fire. I don't know whether Satoshi Nakamoto also imagined or whether guessed whether this Bitcoin will catch up like fire, as we saw. So what happened here is, it is regulated by public, and a protocol makes sure that the supply of currency is deterministic and is visible, is verifiable, which is missing with the central bank currency. And second thing is, if you look at the global transaction or global payments landscape today, as per World Bank, if you do an international transaction, the average cost of international transaction, including the transaction fee, markup fee, SWIFT fee, that fee, this fee, it is around 6.94%. That means the moment you transfer 1 rupee from this country to other country, on average, 6.94% is the value which is captured by these intermediaries. But what happened with crypto? Because by nature it is global, the transactions are facilitated at a sub 1% transaction fee. So that way, the transactions are faster, because the traditional transactions like SWIFT transactions are T+1, T+2, T+3 based on the country from which you are doing the transaction. So speed, time, visibility, authenticity, and certain controls in terms of supply of currency. So these are certain capabilities crypto as a technology has proven or has shown to the world. But what happened? In cryptocurrencies, there is a concept called Nash equilibrium, that is game theory concept, which says if 51% of the network or 51% of the participants are trustworthy, then the system is intact. Otherwise, it will collapse. So the bad players, because these cryptocurrencies by nature are anonymous, because it is a global managed by public, Satoshi Nakamoto can't ask any central authority to do KYC globally to open an account, obviously. That is why cryptocurrencies are designed by nature anonymous, because irrespective of what country you belong to, what background you come from, the money should behave same for everyone. So that is the intent with which anonymity was introduced in cryptocurrencies, because of which some people who have more money in the traditional markets started procuring these cryptocurrencies and started manipulating with the demand of these cryptocurrencies. So what happened? Even if we make something decentralized, protocol driven, and if you put power in the hands of public, they started manipulating it. Or the people who have more money from the traditional system started messing up with the value cycle of these cryptocurrencies. And that is where now central banks who have sovereign authority over money in the traditional markets started seeing, can we leverage the same technology blockchain? And can we bring the capabilities of cryptocurrencies so that people need not look for alternatives? And that is where we saw the rise of central bank digital currency initiatives, by early 2012 and 13. Because by 2012-13, the market cap of Bitcoin and other cryptocurrencies have touched around $1 trillion. And at the peak of Bitcoin recently at $62,000 per Bitcoin, the market cap of these cryptocurrencies is around $3 trillion. So just imagine the gold, the whole gold market cap is $10 trillion, and cryptocurrencies, which just came like a decade back, having $3 trillion at its peak or $1 trillion on average, it's not a simple thing to neglect. And that is where all the central banks across the world started experimenting with central bank digital currencies. And they want to bring back the sovereign control while bringing operational efficiencies, cost savings, time cutting, and also see if they can give certain visibility to the total supply of currency. Whether they will give or not, time will decide. But that is the intent with which central bank digital currency initiatives slowly started catching up. And by 2016 to 2018, 4 out of 5 central banks started doing pilot projects on CBDC. And we saw China launched their eCNY, Bahamas launched Sand Dollar, Nigeria launched eNaira, India launched e-rupee, and now Europe is working on a digital euro project, and US Federal Reserve is also working on a digital dollar project. And across the world, Bank of International Settlements, which is a consortium of around 60 central banks, is leading all these CBDC initiatives. So now let's look at what is this central bank digital currency actually. So central bank digital currency is a sovereign digital currency issued by central bank, and it is issued and controlled by the country's central bank and used by public and businesses for their retail payments or wholesale payments, whatever. Then you might ask, Arvind, like today also we are doing digital payments, right? So how is it different from the digital currencies? See, one important point I want to highlight. The digital payments which we do today are digital payment rails. That means it's an electronic medium of doing debit and credit, and the money moves through the banks. But if you take a central bank digital currency without involving banks also, like how we do peer-to-peer physical cash transactions, atomic transactions, the same way central bank digital currency transactions are atomic transactions. What does that mean? There is no debit on one side, then the transaction goes through central bank central server, and then the credit happens, and then the reconciliation happens. So there is no time gap between debit and credit. Rather, like how we do our day-to-day transactions, physical cash transactions, the transaction settlement happens through a consortium of nodes in the network which are maintained by central banks and banks, and the whole network settles the payments, and credit and debit happens at the same time. So one of the key capability of central bank digital currencies is atomic transactions, which are not the case with the traditional electronic payments, which has a lot of back office work, a lot of reconciliation required. Second, as you know, blockchain has this capability called a smart contract. So central bank digital currencies can have programmability concept, because of which certain transactions can happen just like that. What are they? Like say direct benefit transfers. Now today, Ministry of Health wants to distribute money, like say 1,000 rupees for everyone who has age above 60, let's assume. Now with one smart contract, the Ministry of Health and central bank can initiate, without involving banks or directly, through CBDC, a smart contract can distribute money to the wallets which are eligible based on the Aadhaar date of birth which is attached to that wallet. because CBDC are KYC driven, because it comes under the scope of a particular central bank. And second, all the healthcare service provider wallets can be whitelisted, and a smart contract can actually govern whether the money can move to a particular wallet or not, which is not possible with traditional electronic payment rails. Because in traditional banks, if the other account is a valid account, that money moves, but you can't really program the nature of money transaction, whether the wallet can actually take the money or not. So this kind of sophisticated programmability is not available with the traditional electronic payment systems. They have certain programmability, but predefined, like say employee payroll automation or EMI debits, auto debits. So these are very basic functionalities, but sophisticated programmability can be achieved with central bank digital currencies. And just imagine, only some of the money of this 100,000 which was sent to a wallet was used. Then at the end of the month, all the balances in this direct benefit transfer wallets can be sent back to the Ministry of Health's wallet with one smart contract. So this programmability is one of the amazing capability central banks can play with, utilize, and create more value with less cost. So as I highlighted, the legacy system which we use today, the electronic payment systems which we use today is e-money. That means it doesn't track what exact money, what exact transaction of past you are using to do a transaction. Rather, it is debit, credit, debit, credit. There is a balance which gets updated, and whenever you do a transaction, from the balance, there is a debit. But if you look at a CBDC, central bank digital currency, if you have received some 10,000 from past and you want to do a 5,000 transaction, you take that particular past 10,000 transaction as an input and you do that 5,000. That means you can actually track and trace the money movement using central bank digital currencies. And of course, this is one of the biggest concern by public, whether they to use CBDC or not. Because if you take physical cash transactions, they are anonymous, right? Say, for example, I gave you some 2,000 rupee note. Does anyone know it? No banks track it. No banks know it, because physical cash transactions are anonymous transactions. But central bank digital currency transactions are not anonymous. Rather, they are trackable and traceable at certain level. And that is what creates a trust gap. Oh, even though it is efficient, it has smart contract functionality and all, track and trace is something which is a concern, because privacy is a fundamental right for public around where they are using money and all. Of course, if there is an incident of money laundering or terror financing or some miscellaneous transactions, yes, central banks have right to track and trace, but not every transaction we do. So this is where now central banks are slowly working on privacy preserving central bank digital currencies, so that even though the identity of the people is known, but the transaction details or the transaction is not known or not traceable. So there are certain design choices central banks are working on. But one important point I want to highlight is the e-money which we use today, the digital payment rails which we use today are settled by central bank and processed by banks. So central bank issues the currency, banks facilitate the retail transactions or wholesale transactions between the end customers, and central bank only regulates the money market and settles the transactions. That's it. So central bank reserves are electronic, and all the banks have to reconcile with central bank what are the volumes of transactions they did, and they need to do at the end of the day reconciliation and encashment, and there are certain processes they do. But if you look at CBDC, CBDC is not centralized, rather it is decentralized but permissioned. See, try to understand. If you take public blockchains like cryptocurrencies, they are decentralized, but permissionless. That means anyone can maintain a node there. But if you take a CBDC network, usually it is decentralized or distributed, where nodes are maintained by central bank and banks who are participating in the CBDC initiative. And it is permissioned. That means the users, the banks, the central bank, everyone has digital identity mapped to it, KYC mapped to it. So obviously transactions happen near real time. So one, CBDC will improve or enhance the existing payment infrastructure. Second, when Prime Minister Narendra Modi ji launched this Jan Dhan Yojana, where zero accounts are maintained, what happened? All the banks are reaching out to central bank and say, hey, our cost of maintaining accounts is very high. If zero accounts are maintained, it's an overhead on us. For small amounts, the number of people, footfall come and all, footfall happens at the bank are high. So financial inclusion kind of initiatives is an overhead on banks with the existing payment rails. But if you take CBDC, it can promote financial inclusion, because managing a wallet and the cost of facilitating transactions on this CBDC wallets is very less, very less, because there is no need of reconciliation, back office operations and all these things, because the transactions are atomic. Third, enhance greater competition. Today, if you want to start a bank, it's a nightmare. It's not that easy. Getting a bank license is not easy today. The barrier of entry is very high, because the kind of regulatory processes, audit, compliance, lots of complexity, operational overhead. But if you take CBDC, a moderate small bank also is sharing near real-time data about what is the transactions happening in that bank, because it's a distributed ledger. So we saw recently, right, in Punjab, there is a bank which didn't reconcile with the central bank, and thousands of crores of money went into bad loans. And only when a certain notice happened, it is actually understood that the reconciliation is not happening actually for years. See why this is happening? Because it's based on the reporting. Today, reconciliation is based on the reporting. But if you take a CBDC network, near real-time reconciliation, automatic reconciliation of data happens. And a small bank also who is moderate enough and who is having some innovative services can come, deploy the smart contracts, standards defined by the CBDC network, and they can start giving services. So the regulatory control, the audit, compliance, all this becomes very easy and straightforward with central bank digital currencies. So foster innovation. So now fintech companies also can innovate with smart contracts and can give various services. So we will talk about the use cases of CBDC in coming slides. But one thing I want to highlight is CBDC is foster innovation. And it enables central banks maintain control and also retain sovereign control over money. Because now multi-CBDC, that is one CBDC network talking to other CBDC network initiatives are happening. That means the cost of moving money from one country to other country will also is targeted to be less than 1% by 2025. Why less than 1%? Because cryptocurrencies are doing that or giving that facility, and all central banks came into consensus, and BIS has put a condition or a target which says by 2025, all cross-border payments should be less than 1%. Why? Because if all the benefits or at least some of the benefits of cryptocurrencies can be brought to traditional networks, then obviously people do not have the hassle to convert their fiat money to crypto, do crypto transactions, receive some payments in crypto, convert back into fiat. So all this overhead can go down. That is the intent with which central banks are now bringing CBDCs. I mean, one use case or one scenario. And now let's look at the flower of money. So what is this flower of money? So as per BIS, money basically has 4 attributes. Okay. 1, it is token or value based. It is central bank issued. It is digital, and it is widely accessible. Based on these 4 parameters, money is defined. Now, if you look at cash, physical cash, it is token based because every physical note has a serial number. It is central bank issued. That is why it is in the green circle. It is widely accessible. You can take physical cash. Even if you go to other country, you can convert it because there will be exchanges who do that. So it is widely accessible, but it is not digital in nature. Now let's look at cryptocurrencies or private digital tokens, because Bank of International Settlements do not recognize cryptocurrencies as currencies. Rather, they say it is a private digital token. It's just a medium of exchange of value. It's not a currency. So in that case, it is token based. It is digital. It is widely accessible. But the point is, it's not central bank issued. See, it is out of this green circle. And if you carefully observe, physical cash and these digital cryptocurrencies are at same level in terms of privacy, anonymity, because physical transactions are cash, cryptocurrency transactions are pseudo-anonymous. I mean, they are not purely anonymous, they are pseudo-anonymous. But if you look at CBDC, CBDC is positioned at the center of this flower of money. Why? Because it is token-based or value-based? Because there is token-based CBDC design choice or account-based CBDC choice, okay, which you can explore further. And it is central bank issued, it is digital, and it is widely accessible. So central bank digital currencies are or is the response by central banks to innovate with programmable money. And it is very well positioned. But will it replace the need for cryptocurrencies? It depends on how privacy centric the central bank digital currency design is. Second, how transparent the central bank is in terms of showcasing the total supply of the central bank digital currency. And third, what are the various services central bank digital currency wallet provides? That will decide how much of cryptocurrency and how much of central bank digital currency existence will be in the economy. So one thing we need to understand, the future of money is multi-dimensional. You will no longer use only one type of money. Rather, you will use physical cash, electronic payments, central bank digital currencies, cryptocurrencies, everything. But at what proportion will depend on the design choice and the transparency and the trust the central bank digital currency builds with its architecture. And it is not by default. Please try to understand. See, once upon a time, we don't have an alternative money called as cryptocurrencies. At that time, because money is equal to currency, central bank issued currency, whatever central bank says, that is the only way. But if central banks do not innovate with the programmable money, the adoption of cryptocurrencies will increase. If central bank leverages programmable money and is bringing certain efficiencies which cryptocurrencies facilitate, then the cryptocurrency adoption will go down and central bank digital currency adoption will go up. So it is a dynamic, contemporary actions by central banks which will decide how much it will impact the adoption of cryptocurrencies. But please understand, central bank digital currencies will exist, cryptocurrencies will exist, physical cash will exist, the existing electronic payment rails will exist. All will coherently create the flower of money. And people will deal with all types of monies in future. So this is one important understanding I thought I will highlight. Okay, so if a central bank is saying the aim of the central bank digital currency is to eliminate cryptocurrency, I mean, that's not a sensible approach in my point of view. Rather, we want to bring the best of best capabilities, whatever cryptocurrencies are facilitating, to central bank digital currency network, so that people need not look at alternatives much. Then that is the most sensible approach. Because cryptocurrencies can be regulated with a global action or a global coherence, which is yet to happen. Okay. So the contemporary steps have to be taken to bring the balance. Okay. So because this is moving and we are in a very dynamic environment, what will happen is only decided by the collective actions by central banks, and how people will realize how to deal with self-regulated cryptocurrencies, because people messed up with cryptocurrencies in a big way. So they don't know how to regulate self-regulation or freedom. They don't know how to use the freedom as well. So the future of money is between choice, okay, and the chance. So based on the choices, based on what I want to achieve from my transaction, I will pick that up. And next, now looking at the, so another 5-10 minutes, okay. If you look at CBDC design choices, especially the retail CBDC. See, retail CBDC means a central bank is issuing retail CBDC means it is only for the citizens to use. Okay, the citizens and the banks are involved in that. But there can be different design choices. Indirect CBDC means central bank will issue the CBDC, banks will give the wallet service, and public citizens deal with banks, and all these banks and central bank will be having a consortium blockchain network or a distributed network, distributed ledger network. Second, direct CBDC. That means the central bank will directly do retail services with the citizens without involving banks. Okay, example, e-Naira by Central Bank of Nigeria. There is no banks involved. It is central bank who gave the wallet service and people are using it. That is called direct CBDC. And then there is third type called hybrid CBDC. In hybrid CBDC, banks will only facilitate fiat to CBDC and CBDC to fiat by holding the wallets, but they don't maintain nodes in the network. So obviously, the intermediaries only are for KYC and intermediation. That's it. They don't deal in the transaction settlement. But in direct CBDC, KYC, even the transaction settlement, everything is by central bank. In indirect CBDC, banks also take an active role. But how they split the transaction fee and all, it depends on the, on the policy and the charges decided by the central bank. So 2-tier, single-tier, or an hybrid model. So these are certain ways in which retail CBDC happens. And then, yeah, so retail CBDC is used by citizens. Whereas some central banks decided they don't want to give any retail involvement in the transactions. Rather, they only do wholesale CBDC, like say National Bank of Cambodia. So if you look at National Bank of Cambodia, they did wholesale CBDC. That means the CBDC is used only by banks and financial institutions and non-financial institutions, FIs, NFIs, and PSPs, payment service providers. The citizens still deal with the financial institutions. That's it. They don't directly deal with the CBDC transaction. But if you look at India, Reserve Bank of India, they are doing both retail CBDC experimentation pilot and wholesale CBDC pilot as well. And then we have multi-CBDC. Now, what is multi-CBDC? Multi-CBDC means one CBDC network. That means one central bank digital currency network doing a cross-border transaction with other central bank digital currency network in other country. So this way, cross-border transactions, which traditionally happen through SWIFT, now will happen through CBDC corridor networks. What is CBDC corridor network? A corridor network is nothing but multiple central banks who continuously do remittances and cross-border payments will come together, will create a CBDC network among themselves, which is called as MCBDC, and they facilitate the cross-border transactions. So retail, domestic citizens, wholesale, only FIs, NFIs, and financial service providers. Multi-CBDC, cross-border. Now tell me, if at all, the cross-border payments has to drastically, the price of cross-border transaction has to happen drastically less than 1%. That means all the central banks across the world should have a compatible, I mean, interoperable network, or whether they all come into one single network, it's a different story. There are different design choices which are being experimented by BIS. But consensus should happen between all the banks, all the central banks, which is very, very sensitive, very geographical, political, because what happened with after Russian-Ukraine war? SWIFT was also weaponized. In the sense, a financial infrastructure is used to block certain accounts and to do certain political agendas coming into the financial system. So this way, all central banks now are in shock indeed, I would say, because obviously this is first time in the human history that a financial system is now getting weaponized or is becoming country specific, and also so somewhere the CBDC corridor networks is future, and even these corridor networks will be decentralized. Now say for example, India, Singapore, Thailand, there are certain countries now slowly they created pay now UPI. So recently 2 months back, it's not blockchain based or not CBDC based, but they created, Singapore and India now have pay now and UPI correlation. That means Singapore citizen can just enter an Indian phone number and do a transaction, and an Indian citizen can enter Singapore's phone number and immediately do a pay now wallet transaction. What is happening? The money, the monetary transactions, or the digital payment rails across the world are now slowly getting disintegrated and becoming decentralized. And to what extent they get decentralized, we need to see. But the more disintegrated it becomes, the more intermediation costs will come up, and cryptocurrencies will have that competitive advantage. So in that context, there are lots of dynamics which are playing at multi-CBDC initiatives, and BIS is experimenting with Project Zura, Project Inthalon, Project, what is that? Icebreaker or something, Icebreaker. So there are lots of multi-CBDC experiments which are being done by BIS so that they can pick up a good design choice which can be scalable globally. And last but not the least, one case study I want to highlight is Project Ubin by Monetary Authority of Singapore, which started in 2016. And one thing which I liked about this project, see, I can pick up e-rupee and all, but I thought I'll pick up Project Ubin because this is one of the very early CBDC initiative, which is not in production, but they have experimented with every potential use case. So that is why I picked this as a case study. So what they did in phase 1, tokenized Singapore dollar, that is like digital rupee. Then they disintermediated themselves and they checked whether without active involvement of central bank can RTGS, the traditional RTGS payment rails can be automated, central bank experimented disintermediating themselves and see how the peer-to-peer transactions can happen. That is like wholesale CBDC. Then delivery versus payment. Today, when you buy a stock, the stock gets delivered T+1, that means the next day. and you can sell and the money gets deposited in the next day, like T+1. So sometimes, of course, now the transaction cycles are becoming reduced. But if you look at the T+1, I'm not talking on the user side. I'm talking on the back end as well, the back office, pre-trade, post-trade processes as well. But if CBDC can be integrated with traditional capital markets, delivery versus payment can happen instant. That means the securities ledger and the banking ledger can be brought onto same network and DVP can happen immediately. And payment versus payment, PVP, that is cross-border payment experimentation. Central Bank of Singapore, that is MAS, and Bank of Canada, Central Bank of Canada, they did a PVP transaction, that is payment versus payment, that is cross-border transaction instant, near real time. And they also brought trade finance, supply chain finance, bond tokenization, and certain use cases, which I'll show you soon. And what they did smartly is, when they created this project UBIN, they created a separate account for banks to manage with central bank, so that all the initiatives which happen through Project UBIN happens through this DR cash custody account. That is distributed ledger based receipt is used to settle the transactions. So now let me tell you what is the future, how the future looks like. So last slide, so don't, I crossed a little time, but let me conclude it in a bang way. One important point we need to understand, the future of CBDC is like how in public blockchain space, like Ethereum, if you take, or Ethereum, Algorand, whatever layer one solutions you take, on layer one, you have tokenization, NFTs, decentralized finance, liquidity pools. So like how you have all the services on public blockchains, the same kind of services can be brought on to CBDC. That means CBDC will become layer one for that country. And on top of it, not only C2C, not only peer-to-peer services, but B2C, B2G, B2B transactions also can happen on CBDC network. That means CBDC networks will become more powerful, and the volumes of money which moves on CBDC networks will be more than the cryptocurrencies, because cryptocurrencies is more peer-to-peer. It can be C2C or B2C, because for B2C transactions also you don't need identity of the customer. But for B2B transactions, central bank digital currency tends to be a better choice because it is regulated and it has identity management, compliance requirements, everything. So the future of CBDC is, first of all, the CBDC network will have certain smart contract standards like DVP, escrow, conditional payments, outright payment, payment commitment. So all these smart contract standards will be used by various financial service providers like invoice financing, trade financing, supply chain management, trade, property titles, capital markets, bonds, private exchanges, corporate treasury management. All these various platforms which are in silos will integrate themselves into the CBDC network, so that all transactions happens through the smart contract standards built by the central bank. Second, all central bank digital currency networks will become interoperable with other central bank digital currency networks, so that cross-border payments also happen pretty much near real time at low cost. And on the other side, there will be two types of wallets in future. Everyone will have a personal wallet and a direct benefit transfer wallet. Now, the direct benefit transfer wallet is not privacy driven. Government can track and trace how you are spending that, because the money is coming from public money. But the personal wallet is something which has privacy principles designed into it, so that even though people use CBDC, the transactions are pseudo-anonymous. So if that kind, so that means in future, one CBDC wallet, you will have multiple wallets for multiple purposes, and different smart contracts govern these wallets under that one CBDC wallet. So you can hold your university certificate, your land record, your bonds, your capital markets, like how Ethereum wallet, you can hold different types of tokens and different types of assets. In a CBDC wallet, you can hold all your assets and you can get financing, instant loans, direct benefit transfer, subsidies from government, whatnot. So that is the direction in which central bank digital currencies are evolving. And stable coins. So stable coins is another concept where the reserves are not, I mean, see, in a central bank digital currency, the guarantee is by central bank. The 1:1 ratio is maintained by central bank. That means for every CBDC issued, there is some correlation with the reserves maintained at the central bank. The guarantee is by central bank. But if you take a stable coin like USDT, USDC, BUSD. So we saw multiple US dollar based stable coins. What does these do? These foundations buy US treasury bills or private bank deposits. And based on the deposits, they issue tokens on public blockchains. And those stable coins bring the stability of the fiat money to crypto world. And these stable coins are fiat backed, commodity backed, gold backed, oil backed. And we also saw the non-collateralized CBD stable coins. That is, what is that? Luna, which is algorithmic driven central bank stable coins. What happened with Luna? Bang. One loophole. Someone could mint billions dollars of Luna, and the price of Luna went from $1 to 30 cents to 0 cents just in 2 days. So you can't fully depend on protocols. You can't fully depend on centralized electronic payment rails. Striking the balance between both is what the aim of central bank digital currencies. And that is what I understood from the patterns of various implementations. And I think at the end of the day, if citizens get benefited from a stable economy, verifiable, accountable governments, money, which is being spent through CBDC, and last but not the least, if the regulation by central authority is going good, then self-regulation, the need for self-regulation also may get dimmed in that economy. So the adoption of cryptocurrencies and central banks depends on economy to economy. And let's see how it evolves further. Thank you.
It was a really amazing session. So we have a lot of questions pouring. I think it's time to take a Q&A. So there's a question by anonymous attendee, just asking generally, why do our Indian government is unhappy with the cryptocurrency, and what are the core reasons which is making a trust issue for crypto market in the eyes of government?
Okay. So see, one important point we need to understand. Cryptocurrency has a dual nature. It can be used as a currency. It can be used as an asset. That is where central banks across the world have a problem. Because if you carefully observe, now imagine you have an Apple stock, Vimlesh, okay? Now, can you go to Apple store and buy Apple iPhone with Apple stock?
No.
Obviously no, right? But if you take a cryptocurrency like a token or anything, it has dual nature. You can hold it so that if the company valuation goes up, its value goes up, but you can also redeem this token for the services or products which are provided by that company. So for every central bank, cryptocurrency as a medium of exchange of value, that is currency operation, no. As an asset, yes. So that is why if you carefully observe across the world, many countries, the central bank opposes the cryptocurrencies, whereas the capital markets or Ministry of Finance or the capital markets regulator supports cryptocurrencies, which is good approach because no country wants to lose sovereign control over money. But also the digital products and services which are happening through these cryptocurrencies has certain intrinsic value, and central banks, the capital markets want to allow public to deal with it, but safely. So this is the dilemma because of which we are seeing mixed reactions from multiple government bodies. Got it?
Got it. I hope that clears. And there's one more question. How can a citizen can verify CBDC reserve asset?
Sorry, why? How?
How can a citizen can verify CBDC reserve asset?
Design choice.
Soumya, yeah. This
Okay.
question was asked by Soumya, our guest.
See, if you look at the Web3 mindset, right? White paper is one thing which everyone publishes, right? And they also publish the code, they get the smart contract audited and everything. But do you think that will happen with permissioned blockchains?
No.
Obviously, no. So I think the trust on permissioned blockchains is definitely, irrespective of whatever design choice they publish on papers and everything, at the end of the day, how verifiable it is by the public will decide how much they can trust their central bank digital currency. As simple as that.
There's one more question from Moidin. Who will give the transaction fee in CBDC?
Okay. See, again, it is a sender, obviously, right? Because at the end of the day, who receives is one big question you need to actually ask. It is sender who pays, but who receives? Because see, traditionally, central bank used to take a small transaction fee and banks who settle actually takes the major chunk. But if you take a CBDC network, now all are in one single channel. Let's take the CBDC was built on Hyperledger Fabric. Now you have one channel and you have all the banks, central bank, everyone maintaining one node. And everyone is maintaining the ledger. Everyone comes into consensus with respect to that transaction. Though endorsing happens by the sender and receiver bank, the ledger is maintained by everyone. Now, who should get paid? This is one of the very biggest question and synergy. Now, actually, for every central bank, there is one more challenge when they deal with CBDC. That is synergy cost. Now, say for example, if face value of a 10 rupee note is 10 rupees, to print a 10 rupee note, central bank only gets 3 rupees cost. So that 7 rupees, which when they sell this currency to banks, they sell at the face value. That means central bank also gets synergy benefit, the cost of production and the cost of sale. But if you take digital currency, central bank digital currency, how will you quantify the cost of production, cost of operations of central bank digital currency, and map it to the supply of the central bank digital currency coming out? So these are certain challenges which are still in experimentation stage across central banks. So whatever central banks I worked with, they're still in dilemma. There is no concrete answer for that. All they say is, now at this point of time, we are not looking at the cost of the CBDC network and operations maintenance. Rather, we are only maintaining 1:1 ratio with fiat money, which we usually hold in reserve account, to the CBDC, which we issue.
There's one more question by Saurabh Singh. Is CBDC implemented for the people? If yes, what are the challenges related to the CBDC implementation?
See, there is no challenges as such, nothing. It is central bank who are traditionally the authority. They have full control on the infrastructure and settlement process and everything, right? Now, decentralization is a new concept for them. See, when kingdoms concept moved to democracy, there were a lot of challenges in terms of defining things, correct? Similarly, the problem is not with respect to implementation. The problem is with respect to aligning policy objectives with the implementation. So what are the outcomes they want to look at? And what are the potential unintended consequences which will come out? So these are the challenges. Indeed, to implement a CBDC, it is a cakewalk. It's just a tech solution, which many organizations have already built. And it is just a wallet-to-wallet transactions which are facilitated, and infrastructure is maintained by multiple stakeholders. So tech side, no challenges. Policy side, design choice size, there is a challenge.
There's one more question. What is BIS?
Bank for International Settlements. So Bank for International Settlements is a consortium of 60 central banks. They all come together. It's a common platform. Like what is NASSCOM? NASSCOM is consortium of all software companies in India, right? So similarly, it's a consortium of all around 60 central banks in the world who come together, who discuss what are the policy changes, what are common standards they need to follow across. So it's basically a kind of regulator at a global level.
So there's one more question. There are two more questions. In fact, we'll finish if we're running out of time. So Arjun PK is asking, we will have multi-dimensional currencies in future as discussion. And my question is, which use cases will see more influential with CBDC?
See, for me, CBDCs will play a very vital role in direct benefit transfers. Okay, that is government spending to public. That will be implemented on CBDC. That is why one very good use case. Second use case, trade finance. Third use case, cross-border payments. Fourth use case, asset tokenization. Now, in DeFi, a token is put into escrow and a loan is given. But on CBDC, real world assets like real capital market stocks get tokenized, and decentralized finance kind of services will be built by fintech companies on top of CBDC. So these are certain use cases where I see more traction in coming days.
Yeah, this is the last question. You mentioned swift weaponization. Can you please elaborate this one?
Sorry, what is that?
Swift weaponization.
Swift weaponization. Okay. See, a country to country. See, today, if you carefully observe economy, financial system, geographical, politics, right? All these three things are interdependent, of course, but a political decision should not impact the financial system. Okay, you may put hold, you may put whatever it is, okay, but tomorrow, that means if the country who is having more voice, if other small country raises voice against this country, can you just go and ask, okay, Swift, you no longer give services to this country, cut this country from the things. So somewhere financial system getting weaponized is not a good thing to happen, because trust gap will come, because Swift is a common system which is agreed by all the central banks. They all came into consensus and they are throwing transactions around it. Okay, sanctions is very country to country specific, but using a international payment rail, a way to stop a country to deal with other countries in the world, I think that is definitely some weaponization in my point of view.
Well, your questions are just pouring in. So we'll take two more questions and we'll close this.
Yeah.
So which focusing on, yeah. Which countries focusing on stable coins?
Okay. See, one of the amazing strategy and one country which is benefited from stable coins most is US again. Though the cryptocurrencies innovation happened, initiated across the world globally, but the people who traditionally have more money are the people who adopted it first and they have more control over it. So what happened is, if you look at the traditional cryptocurrency exchanges today, like Binance or Coinbase or whatever you see, the pairs, if you carefully observe, it is US citizens who trade more, and it is US who made crypto, declared crypto as an asset and capital gain tax and everything first, because of which US dollar, USDT, USDC and all this became a predominant way globally. That means today, if an Indian is buying USDT, he is actually buying US dollar, which is illegal, obviously, right? You can't just trade within the country using, you can't use US dollar as a medium of exchange of value. But because of this cryptocurrency exchanges and stablecoin dominance by US dollar, backed by US dollars, the biggest irony is cryptocurrencies came with the intent of becoming a medium of exchange of value, but people made it a set and they are trading it with US dollar, and they brought US dollar backed stable coins into the cryptocurrency economy. And this is biggest irony. And it is US dollar which is getting benefited the most, because it recently made USDT, which used to put all the reserves on commercial paper based or bank reserve based, to convert all that into US treasury bills. That means today all the USDT in circulation, the money went to US treasury. And that is why they are not interested in US dollar, digital dollar project, than they're more interested in stable coin, because that is benefiting their economy the most. And this is what now other countries realized, and they slowly started bringing stable coins based on Singapore dollar. Australia is coming up with their own stable coin, and certain central banks are now experimenting with stable coin. Because till the multi-CBDC corridor network happens globally, stable coin can become an intermediary for facilitating cross-border payments quickly. Okay, so thank you so much. I see everyone enjoyed the session, and I hope the questions got stopped. But I see 100 comments. I thought 100 questions. So let me.
Yeah, the questions are coming. So what I suggest for the folks, we're already running out of time. Already extended the session. So whatever the question you have, please try to post in our community. We'll try to get that answer from Arvind. Most of them are asking, regarding the session recording. So definitely we will be sharing our session recording.
So did you look at Q&A, Vimalesh? We have 3 questions in Q&A.
Yes, we have 3 questions in Q&A.
So let me address them and we'll wind up. Okay.
Yes.
Few more minutes.
Sure.
If some of you want to leave, it's okay. You can leave, but the people who have the questions, you can stay. So can you just provide the time frame the digital currencies would come into effect? See, I think, if you look at the cryptocurrencies, it had multiple cycles, up and down, up and down, up and down, right? So the next wave of cryptocurrencies which come into picture, people will deal with cryptocurrencies not with a speculative mindset. See, once upon a time, any new token launched, people used to invest. But now people became informed, and they deal with cryptocurrencies which has certain intrinsic value, sustainable value. That means people now became more informed investors or informed people when they deal with cryptocurrencies. Okay. So in that context, when this digital currency adoption will happen, one, it is already happening. And the only problem is central bank digital currency will be successful only when it has multiple use cases like public blockchains on top of it. And bringing such vast stakeholders onto one network, and that too in a permissioned blockchain network, the governance issues are very complex. Whereas in public blockchain, the protocol is a simple governance structure which is embedded into the protocol, and everyone who maintains a node follows the protocol, and based on the number of people who believe in that protocol will contribute to that, and value will increase based on the size of people who are adopting it. But in a central bank digital currency, you have multiple hierarchies, multiple governance structures, policies which are to be defined, which will take years. So in my point of view, it is at least a decade away in terms of mass adoption of central bank digital currencies. At least a decade. I mean, a full-fledged global CBDC adoption. Okay. And do you think developing countries will benefit through this CBDC? Definitely, yes. More than, if you carefully observe, more than West, it is Asia and Africa who is innovating on central bank digital currencies, because it is definitely going to benefit them, because the size of the people and the volumes of transactions happen in Asia and Africa is higher, and central bank digital currencies will bring operational efficiencies which are beneficial for the people. So each country has its own currency. It has value compared to GDP. If all country adopt this digital currency, then how the face value will be calculated and what will happen if any country is trying to take dominance? Yes, Gyanendra, I think that is a very interesting question. And that will only be decided based on how much consensus is achieved across the central banks in terms of what is the volumes they print. Today, anyone who questioned a country's dominance, I don't want to name the country, they all somehow got impacted very badly. And we saw US, China yuan, and euro, and now e-rupee trying to dominate in the South Asian region. So that means the future of currency is no longer one currency, central banks or one country's currency will have the dominance. No, it will be decentralized again. So how fair a central bank is, how fair the currency issuance is backed by the value, economic value. See, you said it is backed by GDP. See, even GDP, which is published, is not verifiable. It is not accountable. It is just based on the trust on the country and the pattern in which money value is changing. People trust it with certain percentage weightage. That's it. Okay. So the point is money, currency, value are three different things. Coming to value of a money, it has intrinsic value, perceptional value. It is very intangible. So no one in the world can clearly say which currency will dominate at any given point of time. All we can see is multiple currencies dominating in multiple regions, and they will have interoperability and conversions as usually. Okay. So no, I don't see any near real time or any time in future that all central banks in the world will come into consensus. If that happens, that is an amazing thing to happen. And that success is attributed to Bitcoin, because it is Bitcoin which created an alternative, which made the central banks to come up, to stand up and speak with each other, collaborate with each other, and create a network across the world. So the success of Bitcoin or cryptocurrencies for me doesn't depend on how much value appreciated of Bitcoin, rather how much it pushed the incumbent players to innovate and make themselves better and efficient. Okay. So with that, I conclude. Of course, all the things I shared, some of them are my perspectives, some of them are facts, and some of them are what I anticipate in future based on the patterns I see in terms of adoption. So if you have some contradicting approaches or views, it's okay. We all can't see the same thing in same way. I appreciate that and I support it. So if you have any queries in future, you can reach out to me on my LinkedIn profile with Voruganti Arvind. So Vimlesh, just give me a moment. Let me put my LinkedIn profile here so that people can reach out to me.
Yes.